Hello everyone and welcome to the channel Contract Simplified. In today's video, we'll be studying about pricing modules in contract. Pricing modules in contract refer to the sections of a contract that outline how the pricing or cost structure of goods or services will be determined and managed. These modules are crucial as they establish the financial aspect of the agreement, ensuring that both the parties are on the same page regarding costs involved. Pricing modules in contract can vary widely depending on the nature of the agreement. Now, let us study about the kinds of contract pricing module. The first one is cost plus pricing module. Cost plus pricing is a pricing strategy used by business to determine the selling price of a product or service. In this model, the selling price is set by adding a certain markup or profit margin to the cost of producing or delivering the product or service. It's a straightforward method that ensures that a business covers its costs and generate a desired level of profit. In the cost plus pricing module, the first step is to calculate all the costs associated with producing or delivering the product or service. These costs can include direct costs such as material and labor directly related to the product, as well as indirect costs like overhead, utilities, and administrative expenses. After calculating the cost, the business decides on a desired profit margin. This is the additional amount that will be added to the cost to arrive at the final selling price. The profit margin can be expressed as a percentage of the cost or as a fixed dollar amount. The profit margin is then added to the total cost as markup. The result is the selling price that the business will charge for the product or service. Once the selling price is calculated, the business sets this as the price of the product or service. This price is intended to cover all the cost and provide the desired profit. The advantage of cost plus pricing is its simplicity, that it's a straightforward method to calculate the selling price, making it easy for business to understand and apply. This method ensures that all the costs, both direct and indirect, are covered, reducing the risk of losses due to underpricing. The business knows that it will achieve a predictable profit for each sale, which can help with financial planning. It has certain limitation, that is, cost plus pricing does not take into account customer demand, competitive pricing, or the perceived value of the product in the market. If the costs are miscalculated or if the profit margin is set too high, the selling price might be too high compared to what customers are willing to pay. This method doesn't optimize profit based on what the market is willing to pay. It assumes that customers will pay whatever is required to cover cost plus the desired benefit. Cost plus pricing is often used in industries where costs can be accurately calculated and hence there is less variability in market condition. However, in more competitive and dynamic markets, other pricing strategies like value-based pricing or competitive pricing must be appropriate. Example, the company calculates all their costs associated with producing the dining table, which amounts to rupees 3,500. Then they decide on a 20% profit margin, which translates to a markup of rupees 700. Adding this markup to the cost gives them a selling price of 4,200 rupees for the dining table. Moving next, we have value-based pricing model. Value-based pricing is a pricing strategy that focuses on setting prices for products or services based on the perceived value they provide to customers rather than solely relying on production cost or competitor pricing. This approach takes into account the benefits, outcome, and solution that customers derive from using a product or service, and prices are set accordingly. To implement value-based pricing, a business needs to have deep understanding of its target customers, their pain points, and the benefits they expect from the product or service. This involves conducting market research, customer surveys, and interviews to gain insights into what customers value the most. Not all customers have the same needs and preferences. Value-based pricing may involve segmenting the customer base and tailoring pricing strategies for different segments based on the unique value proposition perceived by each group. Once the value drivers are identified, business should attempt to quantify the value in monetary terms. This could involve estimating how much money the customer saves, the additional revenue they generate, or the time they save by using the product or service. This helps in justifying the higher price. After quantifying the value, the next step is to set a price that captures a portion of that value. This price must be higher than what a cost based approach would suggest, but customers are more likely to accept it because they can see the return on investment. Effective communication is essential in value based pricing. Business needs to clearly articulate the benefits and outcomes customers can expect from using their product or service. This could involve using case studies, testimonials, and other evidence to support the value proposition. Value based pricing is not a one time decision. It requires constant monitoring of customer feedback, market trends, and competitors' action. Prices may need to be adjusted as circumstances change to ensure that the perceived value remains aligned with the pricing. The primary benefits of a value-based pricing model includes higher profit margins. Since customers are willing to pay more to their higher perceived value, business can achieve higher profit margin compared to cost-based pricing. With its customer-centric approach, value pricing aligns pricing with customer needs and preferences, leading to improved customer satisfaction and loyalty. By focusing on value, business can differentiate themselves from competitors and avoid getting into price wars. Value-based pricing allows business to adjust prices based on changes in the market and customer demands. However, implementing value based pricing can be challenging. It requires a deep understanding of consumer psychology, effective communication, and continuous monitoring of the market. It's important to strike the right balance between the perceived value and the price to ensure that the customers perceive the offering as worth the cost. Example: Starbucks is a company that has successfully implemented value based pricing. Starbucks coffee is often placed higher than that of its competitors, but the company delivers a unique customer experience that justifies that premium pricing. The value comes from the ambience of their coffee shops, the quantity and variety of the coffee and food offerings, and the personalized service baristas provide. This value based pricing strategy has allowed Starbucks to differentiate itself from the other coffee chain and build a loyal customer base. Next one is Harley pricing model. The Harley pricing model is a common method used by business to charge clients or customers for the services they provide. In this model, the price for a particular service is determined based on the number of hours it takes to complete that service. This approach is often used in industries such as consulting, legal servicing, freelancing, software development, and more. In a hourly pricing model, the hour rate is the amount of money charged for each hour of work performed by the service provider. This rate can vary widely depending on factors such as the skill level of the provider, the complexity of the task, the market demand for the service, and the provider's overhead cost. Before starting a project, the service provider typically provides an estimate of the number of hours it will take to complete the task. This helps the client understand the potential cost of the project based on the hourly rate. To accurately bill clients, the service provider needs to track the amount of time spent on the project. This can be done manually through time tracking tools, software applications, or automated systems. Service providers invoice their client based on the number of hours worked multiplied by the hourly rate. Invoices often include breakdown of the hours spent on different tasks and the corresponding charges. The hourly pricing model offers flexibility for both the service provider and the client. The client can control the scope of the project and the number of hours worked, while the provider can adjust their availability and workload accordingly. Hourly pricing provides transparency in terms of how the charges are calculated. Clients can see exactly how much time was spent on each aspect of the project. If the scope of the project changes during its course, it can impact the number of hours required to complete it. In such cases, the provider and the client need to communicate and adjust the project's budget and timeline accordingly. While hourly pricing provides for transparency, it can also lead for uncertainty to clients, as the final cost may vary depending on how long the tasks took to complete. To mitigate this, some business provide maximum budget cap or offer fixed price option for certain projects. In some cases, service providers might combine hourly pricing with value-based elements. This means that while the base rate is hourly, the overall price is influenced by the value of the service brings to the client's business. Regular communication between the service provider and the client is crucial in the hourly pricing model. It helps manage expectation, provide updates on the progress, and address any concern. Remember that the hourly pricing model might not be suitable for all type of service or projects. Some clients prefer fixed price contracts that offer a predictable cost, while others might see the value in paying for expertise by the hour. It is important to consider the nature of service, the client's preference, and the competitive landscape when deciding on the pricing model. Example, if your rate is rupees 100 per hour and it takes you 100 hours to complete a project, then you can walk away with rupees 10,000. Next one is equity pricing model. Equity pricing models are mathematical framework used to estimate the fair value of a company's stock or equity instruments. These models are essential tool for investors, analysts, and financial professionals to make informed decision about buying or selling the stocks. Several equity pricing models exist, each with its assumption and methodologies. Here, the prominent ones are dividend discount models. The Grodon growth module is a widely used in DDM. It assumes that the dividends grow at a constant rate indefinitely. Free cash flow to equity model. This model values equity based on the projected future free cash flows available to shareholders. Price earnings ratio model. This model compares company stock price to its earning per share. Relative valuation model. These models compare to a company's valuation to that of the similar companies within the same industries. Common metrics include PE ratios, price to book ratios, and other ratios. Residual income model. This model calculates the equity value by adding the present value of a future residual income to the book of equity. Option pricing modules. Here, the companies calculate the theoretical value of an option based on factors like the stock price, option strike price, time to expiration, volatility, and risk-free rate. It is important to note that these models are simplifications and rely on various assumptions. The accuracy of their result depends on the accuracy of the input assumptions, such as growth rates, discount rate, and future cash flows. Additionally, market sentiment, macroeconomic factors, and other non-mathematical influences can also impact the equity prices. Therefore, equity pricing modules should be used as a tool for analysis rather than the definitive predictor of stock prices. Next, we have performance-based pricing modules. A performance-based pricing module is a pricing strategy in which the cost of a product is determined based on the results or outcome achieved for the customer. Instead of charging a fixed fee, the price is tied up to specific performance metric or key performance indicators that are relevant to the customer's goals and objectives. This type of pricing module aligns the interest of the provider and the customer by linking the payment to the actual value delivered. The provider and the customer collaborate to define the performance metric that will be used to measure the success of the product or services. These metrics could include things like increased sales, improved customer satisfaction, reduced cost, higher website traffic, or any other quantifiable measure of success. Clear performance targets or benchmarks are established. Targets are often based on the customer specific needs and expectation. They serve as the basis for determining whether performance has met the agreed standards. The price of the product or service is calculated based on how well the agreed upon performance metrics are achieved. The pricing structure can vary, but it often involves a baseline fee or lower fee coupled with variable components tied to the degree of performance achieved. For example, the price might increase if the performance exceeds the target or decrease if the performance falls short. Both parties regularly monitor the performance metrics and assess whether the targets are being met. Accurate tracking and reporting are crucial to ensure transparency and trust in the pricing arrangement. Depending on the achieved performance, payments are adjusted accordingly. If the performance surpasses the targets, the customer pays a higher fee. Conversely, if the performance is below the targets, the price must be adjusted downwards. The benefits of the performance-based pricing is that the pricing model aligns the interest of the provider and the customer as both the parties benefit from the successful outcomes. The customer's risk is reduced since they pay based on the actual result rather than upfront fees. The price reflects the actual value delivered to the customer, enhancing the perceived value of the product or service. Performance metrics can be tailored to each customer's unique goal and objective. Challenges of performance based pricing are setting up and managing the pricing modules that can be complex, requiring accurate data measurement and reporting mechanism. Defining and measuring performance metrics that accurately represent value can be subjective and require careful negotiation, and provider might face unpredictable revenue if performance fluctuates significantly. Overall, a performance based pricing model can be beneficial when there's a clean and quantifiable way to measure the value delivered to the customer. It's important to establish clear expectations, metrics, and a fair pricing structure to ensure a successful partnership between the provider and the customer. Example, if a client has hired your agency to help them increase the number of sales they received, your earning will be result of how many sales the company has made. Next one is retainer pricing model. The retaining pricing module is a business arrangement where a client agrees to pay a predetermined fee to the service provider or consultant on a regular basis, typically monthly or quarterly. This fee guarantees the client access to a specified amount of services, time, or resources from the service provider. It is commonly used in various industries, including consulting, marketing, legal service, design, and more. For service providers, the retainer model offers a steady stream of income since clients commit to paying a fixed amount regularly. This predictability can help stabilize cash flows and allow the provider to plan resources accordingly. Clients benefit by having a certain level of service or assistance available to them whenever needed. It also provides a sense of priority and exclusivity in terms of response time and attention. The retainer model can be flexible in terms of what services are covered under the retainer agreement. It can encompass ongoing consultation, specific task, maintenance, or a combination of services. Depending on the specific terms of the retainer agreement, clients get a better deal in terms of pricing compared to paying for each service separately. The ongoing nature of the retainer agreement fosters the long term relationship between the client and the service provider. This can lead to a deeper understanding of the client's needs and better tailored services. It's important to define the scope of services and deliverables clearly in the retainer agreement to avoid any misunderstanding or scope creep. The retainer agreement should outline terms for terminating the agreement and any provisions for adjusting the retainer fee or scope of services over time. Depending on the retainer model, there might be a limit on the number of hours or services included in the retainer. Additional work beyond the retainer might be billed separately. The retainer model can work differently across industries. For example, a marketing agency might offer a retainer for a certain number of hours dedicated to different marketing activities, while a lawyer might offer a retainer fees for certain amount of legal consultation time. Overall, the retainer pricing models provides benefit for both clients and service provider, offering predictability, ongoing support, and a platform for building long-term working relationship. A freelancer charges rupees 100 an hour and averages 10 hours a month with a client. In the agreement, they could charge rupees 80 with a guaranteed monthly income of rupees 800 as a retainer fees. Moving next, we have fixed price contract. A fixed price contract is a type of legal agreement or contract commonly used in business and project management. This type of contract, the agreed upon price for goods or services is predetermined and remains fixed throughout the duration of the project or transaction, regardless of the costs or overruns or unexpected expenses incurred by the contractor. The most defining characteristic of a fixed price contract is that the price is set at the beginning and does not change, even if the actual cost for the contractor increase due to unforeseen circumstances. The risk associated with cost overruns and project delays and other unexpected expenses is primarily borne by the contractor rather than the client or buyer. The contractor must carefully estimate all potential costs and risks to ensure they can fulfill the contract within the agreed upon price. The scope of work, deliverable, and specification are usually well defined in the contract to maximize ambiguity and potential disputes. Any charges or modification to the scope may result in additional charges or negotiation. Fixed price contracts can provide incentives for contractors to complete project efficiently and manage cost effectively, as any savings they achieve will contribute to their profit margin. Clients benefit from the predictability of cost and reduced financial exposure to unexpected expenses. However, this comes at the cost of less flexibility in accommodating changes during the project. There are variations of fixed price contracts such as firm fixed price incentive fees, fixed price with economic price adjustments. These variations introduce different level of flexibility and risk sharing between the parties. Fixed price contracts are suitable for projects with well-defined requirements, stable condition, and limited potential for changes. They are commonly used in industries like construction, manufacturing, and software development for projects with clear specification and minimal expected charges. However, for projects where the scope is uncertain or changes are likely, other contract types like time and material contract or cost reimbursable contract might be more appropriate. It's important for both parties involved in a fixed price contract to have a comprehensive understanding of the terms, scope, or potential risk. Proper risk assessment, communication, and clear documentation are crucial to ensure the successful completion of the project without unexpected conflicts or financial issues. The firm fixed price contract is a type of contract used in procurement and project management, often in the context of government contracting or business transaction. In this, the buyer agrees to pay a fixed price to the seller for the completion of a specified scope of work, goods, or services. This type of contract places the majority of the risk and responsibility on the seller. Fixed price contract with escalation is a type of contractual agreement often used in business and project management, particularly in industries where costs are subject to change due to external factors such as inflation, fluctuation in market prices, or changing economic conditions. This type of contract combines elements of a fixed price contract and a cost escalation provision. Fixed price incentive is a type of contract used in project management and procurement, often in government or commercial setting. It's a contractual arrangement between the buyer and the seller that defines how project will be executed and how payments will be made. In an FPI contract, the total price is fixed, meaning that the agreed upon amount of money to be paid for the project remains constant regardless of the actual cost incurred by the seller during project execution. However, unlike a simple fixed price contract where the price remains fixed regardless of performance, an FPI contract includes incentives designed to encourage the seller to meet certain performance or targets. FPI contracts are used when the buyer wants to mitigate risk associated with the project cost overruns while also providing incentives for the seller to manage their cost effectively. These contracts promote collaboration between the buyer and seller and encourage the seller to find cost-saving solutions and improve project efficiency. Example, the seller must complete the project for $100 in line with the clearly described requirements. Moving next, time and material contract. Time and material contract is a type of contract used in project management and procurement where the payment is based on the actual time spent and material used to complete a project or provide a service rather than a fixed price. T&M contracts are commonly used when the scope and requirements of a project are uncertain or unlikely to change during the course of project. The contract specifies the hourly or daily rates for labor time, and the cost of the material that will be reimbursed by the client. The contractor is required to keep track of the hours spent by their employee or subcontractors on the project. These hours are usually documented with timesheets or other similar records. The contractor is reimbursed for the cost of material, suppliers, and other projected expenses such as travel expenses that are directly attributed to the project. T&M contracts offer more flexibility than fixed price contracts. They are suitable for projects where the scope is not well defined and changes are expected. This allows for adjustment as the project progresses and the requirements evolve. Contractors typically provide regular reports to the client detailing the hours worked, materials used, and expenses incurred during a specific period. These reports help to maintain transparency and accountability. In a T&M contract, the client bears more of the risk associated with the project changes and uncertainties. Since the final cost is not predetermined, the project might end up being more expensive than initially estimated. Proper documentation is crucial in T&M contracts. Both parties need to maintain accurate record of work performed, hours worked, materials purchased, and any other associated expenses. Sometimes T&M contracts include not to exceed clause that sets a cap on the total cost that the client will pay, providing some cost control. T&M contracts are commonly used in industries where project requirements are subjected to change, such as software development, consulting, construction, and research. However, due to the potential of an unopened costs, client and contractors must communicate effectively and manage expectations to avoid disputes and ensure successful project delivery. It's worth noting that T&M contracts provide flexibility. They also require careful monitoring and management to prevent cost overruns and ensure that the project stays on track. Example, a contract that stipulates $30 hourly rate plus an additional 10% on any item purchased. It also states that the buyers will not pay more than $1,000 in material and in excess of 80 hours of labor. Moving next, we have cost reimbursement contract. Cost reimbursement contract is a type of contractual agreement commonly used in government contracting and in certain industries where the scope of work, cost, and risk involved are uncertain or difficulty to estimate accurately. This type of contract allows for reimbursement of the contractor's allowable cost within certain limits, along with an additional fee or profit margin. In a cost reimbursement contract, the contractor is reimbursed for the allowance cost they incur during the execution of the contract. These costs typically include direct labor, material, subcontractor cost, overhead, and other relevant expenses. However, the contractor's profit or fee is negotiated separately and is often calculated as a percentage of the total allowable cost. This means that the contractor has the potential to earn a profit based on the cost of performing the work, regardless of whether the project goes over the budget. Cost reimbursement contracts are generally used in situations where project's requirement or conditions are uncertain, making it difficult to accurately predict the final cost. These contracts provide a degree of flexibility for both the contracting agency and the contractor to manage changes and uncertainties that may rise during the project's execution. However, because the contractor is reimbursed for costs, there is less incentive to control costs rigorously, which can lead to concerns about cost overruns. There are different variations of cost reimbursement contracts, including cost plus fixed fee contract. In this type of contract, the contractor is reimbursed for allowable cost and is also paid a predetermined fixed fee as profit. This fee does not vary based on the actual cost incurred, providing the contractor with the set of level of profit. Cost plus incentive fee contract. In this contract, the contractor's fee is determined based on the cost incurred and performance against certain predetermined performance target or metrics. If the contractor meets or exceeds these targets, they can earn a higher fee than initially agreed upon. Cost plus award fee contract. This type of contract involves a subjective evaluation of the contractor's performance by the contracting agency. The contractor's fee is based on agency's assessment of their performance, which will typically tied to specific criteria or objectives. It is important to note that while cost reimbursement contracts offer flexibility and the ability to handle uncertain situations, they also carry a higher level of risk for the contracting agency as the cost can escalate beyond the initial estimates. These contracts require careful monitoring, oversight, and effective communication between the contracting parties to ensure that the project stays within the budget and meet the desired outcomes. Next one is unit price contracts. Unit pricing contracts, often referred to as unit price contracts, is a type of procurement contract used in construction and other industries. It is a contractual agreement between the buyer and the contractor where the contractor is compensated based on the quantities of work completed and units delivered multiplied by agreed upon unit prices. In unit pricing contract, the scope of work is broken down into specific measurable units such as cubic meters of concrete poured, linear meters of road constructed, tons of steel used, etc. For each unit of work, a unit price is established in the contract. The total payment to the contractor is then calculated by multiplying the quantity unit of each work completed by its corresponding unit price. This provides a transparent and flexible method of determining the payments as the contractor is reimbursed for the actual work done. Unit pricing contracts are often used when the exact scope of work cannot be precisely defined in advance or when changes in the project are likely to occur. They provide a way to accommodate changes without having to renegotiate the entire contract. This makes them particularly suitable for projects where uncertainties exist, such as construction projects with varying soil conditions, unforeseen design changes, or projects in remote locations with challenging conditions. Advantages of unit pricing contracts include adaptation to changes in the project scope without major contract revision. The payment calculation is based on actual quantities and agreed upon unit prices, providing transparency to both the parties. Risk associated with uncertainties in the project scope are shared between the buyer and the contractor, and they can expedite the payment process since it's based on completed units of work. However, there are some potential drawbacks like managing and verifying quantities of work completed can be complex and time consuming. Disagreements can arise over quantities measured or the appropriate unit prices, and while they accommodate changes, frequent or significant changes can still disrupt the project. Overall, unit pricing contracts can be a useful tool in managing construction projects or other undertakings with an uncertain or evolving scopes. It's important for both the parties to clearly define the units of work and establish accurate unit prices and maintain a communication throughout the project to ensure a successful outcome. The last one is milestone pricing contract. Milestone pricing is a type of contract structure often used in project-based or service-based industries. It involves setting payment terms and amounts based on the completion of specific milestone or deliverables throughout the duration of the project. This approach ensures that both the client and the service provider have clear expectation about the progress of the project and the corresponding payments. The contract should clearly outline the project scope and objectives and the scientific milestone that need to be achieved. Each milestone should be well defined, measurable, and tied to a specific deliverable or achievement. For each milestone, there is an associated payment amount. The payment structure can vary widely on the nature of the project and agreement between the parties. Typically, more complex or critical milestone, the higher payment associated with it. The contract should include an estimated timeline for completing each milestone. This helps in managing expectations and ensuring the project stays on track. Before a milestone is considered complete and payment is due, the client usually has the opportunity to review and deliverable associated with that milestone. If the deliverable meets the agreed upon criteria, it is accepted and the corresponding payment is triggered. The contract should outline the payment terms, including the due dates for each milestone payment. These terms could be based on specific calendar dates, the completion of the previous milestone, or any other agreed triggers. Sometimes the project scope or milestone may be adjusted due to unforeseen circumstances or changes in requirements. The contract should include provision for handling such changes. However, they might impact the milestone schedule and pricing. Once all milestones are completed and accepted, the project is considered finished. The final payment associated with the successful completion of the last milestone. Milestone pricing contracts offer several benefits like clear milestone and payment term provide transparency for both the parties involved. Payment tied to deliverable reduces the risk of non-performance or dissatisfaction. It motivates the service provider to meet the milestone and deliver high quality work to receive payment, and also it allows for adjustment in project scope and priorities. However, if a milestone is delayed, it can impact subsequent milestone and the overall project timeline. Disagreements over milestone completion and acceptance criteria can arise in managing changes in project scope can be complex within the milestone framework. Overall, a milestone pricing contract can be an effective way to structure payments in project where progress can be measured in a well-defined stage. It's crucial for both the parties to have a comprehensive and well-drafted contract that covers various scenarios, ensure a smooth project execution process. So this is all about the pricing modules in contract. I hope this video was informative and it was easy to understand. Thank you everyone for watching, and before moving on to the next video, please do not forget to like, share and subscribe to the channel. Thank you. Payments. The contract should clearly outline the project scope and objectives and the scientific milestone that need to be achieved. Each milestone should be well defined, measurable, and tied to a specific deliverable or achievement. For each milestone, there is an associated payment amount. The payment structure can vary widely on the nature of the project and agreement between the parties. Typically, more complex or critical milestone, the higher payment associated with it. The contract should include an estimated timeline for completing each milestone. This helps in managing expectations and ensuring the project stays on track. Before a milestone is considered complete and payment is due, the client usually has the opportunity to review and deliverable associated with that milestone. If the deliverable meets the agreed upon criteria, it is accepted and the corresponding payment is triggered. The contract should outline the payment terms, including the due dates for each milestone payment. These terms could be based on specific calendar dates, the completion of the previous milestone, or any other agreed triggers. Sometimes the project scope or milestone may be adjusted due to unforeseen circumstances or changes in requirements. The contract should include provision for handling such changes. However, they might impact the milestone schedule and pricing. Once all milestones are completed and accepted, the project is considered finished. The final payment associated with the successful completion of the last milestone. Milestone pricing contracts offer several benefits like clear milestone and payment term provide transparency for both the parties involved. Payment tied to deliverable reduces the risk of non-performance or dissatisfaction. It motivates the service provider to meet the milestone and deliver high quality work to receive payment, and also it allows for adjustment in project scope and priorities. However, if a milestone is delayed, it can impact subsequent milestone and the overall project timeline. Disagreements over milestone completion and acceptance criteria can arise in managing changes in project scope can be complex within the milestone framework. Overall, a milestone pricing contract can be an effective way to structure payments in project where progress can be measured in a well-defined stage. It's crucial for both the parties to have a comprehensive and well-drafted contract that covers various scenarios, ensure a smooth project execution process. So this is all about the pricing modules in contract. I hope this video was informative and it was easy to understand. Thank you everyone for watching, and before moving on to the next video, please do not forget to like, share and subscribe to the channel. Thank you.